think the most important thing for investors is to have realistic expectations when it comes to their portfolio.
A lot of people use the S&P as their benchmark.
Right. So I've noticed even in just the past few weeks, we've had clients who they think they should look like the S&P, but yet in reality, they have like a 60-40 mix. And what I mean by that, it's maybe 60% is in equities or stocks, and only 40% is in fixed income. And so they're comparing it to like an all equity index, which isn't a realistic expectation. And what happens with investors if they don't have a realistic expectation of what their portfolio should do, how it should perform, they just get very frustrated and they make, the wrong decisions at the wrong time, and then they think they're the coach, and then they don't even talk to their coach before making important decisions about their portfolio. So I think, especially right now with the S&P, which is the Standard & Poor's 500 largest stocks in the United States based on capitalization, and that's what, on the media, they say that's basically the market. And so investors are looking at that, and they're wondering why their portfolio doesn't look like the S&P. So I think it's really important that we address that topic today.
So what we're going to be talking about is, why am I underperforming the S&P?
Yeah.
Well, one of the reasons that you brought up is very, very good, is if you had the S&P is only 60% of your portfolio and you had 40% in fixed income, and those were the only two categories you had in your portfolio, you will underperform the S&P 500 because you have a more conservative portfolio. But let's say that you didn't have 40% in fixed income, but you had full equity exposure, okay? That would be like 100% in the S&P 500. So why are we underperforming the S&P 500? Well, the simple answer is we don't have all of our money in the S&P 500. Right. So we'll never look like it.
Right.
Okay? And then if you're in the U.S., you're diversified in our portfolio into shares of mutual funds that include small cap and value stocks. So that's not the S&P 500.
S&P is large.
Large. The 500 largest company. And that index has been around for years. But let's take a look at 2014. This is very interesting. We look at 2014. Which category would you want to be in?
Well, the S&P.
S&P 500.
Sure.
13.69%, because you think, well, that's done well, especially when you compare it to the other areas, and you can see the small cap values down at the bottom, 2.75, or micro caps even less than that.
Yeah.
So they all underperformed 2014.
So you can see where the question's coming from.
Yeah. And this has only happened in 1 year, okay, where the S&P has been up this much. So let's take a look from 2000 to 2014, a 15-year period. Which category would you want to be in?
Oh, small cap value.
Yeah, almost 14%. That's why we're not going to look like the S&P 500. We don't want to look like the S&P 500.
But you'd also, those other returns for the small cap and the small cap and the micro cap and the value, all of those have some decent returns. So you wouldn't really want to choose just S&P versus value, because that for 15 years had the highest. You'd really want to be picking up those other areas as well.
Right. And this is a larger group of companies than just the S&P 500. And in 15 years, it even outperformed the S&P 500.
By quite a bit.
Yeah. So we do not want to look like the S&P 500, because one of the things that we do that the S&P 500 is not doing, as well as what probably some other investors are not doing, is we want to pick up the equity premiums from that the three-factor model give us. One, we get a premium for being in equities versus fixed income. Two, we get a premium for being in small stocks over large stocks. And three, we get a premium for being in high book to market or value stocks versus low book to market, which is growth stocks.
And Eugene Fama won the Nobel Prize 2 years ago for the three-factor model, because he's saying when you're invested in the market, if you use these factors, being in the market, small stocks over large, and value stocks over growth, you can get these additional premiums. You can expect to add some premium to your portfolio versus just being in those large companies.
Correct, and it's not going to show up every year, as we're going to see here. For example, the small risk premium, which is small stocks, versus large stocks. If we look at each year from 1926 through December of 2014, and we look at it on a monthly basis, we had 1,056 months in that time period. So if we look at each month, we see that the number of periods is small beat large is 568 months out of the 1,056 during that period. But let's go out 20 years and look at 20-year rolling time periods. So this would be the first rolling time period of 20 years would be around January of 1946, and then February of 46 would be the second, March 46 would be the third, and so on and so forth. And we would get 20-year rolling time periods from like January 26th through December of 14. We look at that and we look at the 20-year rolling time periods. Look what happened. The number of periods, the small beats large, goes up from 568 to 681. The total number of periods drops to 828. We're getting fairly close to 100%. We're not there. But
so
you can see
54% of the time in 1 year rolling periods,
right,
small beat large stocks, and for a 20-year rolling time period, 82% of the time. That's pretty good.
That's pretty good.
That's really
We're
good.
moving closer to 100%, but we're
Right.
not going to get there. But okay. So let's take a look at the value premium. Remember, we talked about the book to market on value stocks being higher than book to market value on growth stocks. Same thing. We're looking at the same time period, and we're looking at the number of months. Let's go out to 20 years.
96%.
We're getting real close to 100%. Okay, but we're not there. But
so 96% of the time, the value stocks will beat the growth stocks.
Yeah. So
which growth
on
stocks
20-year
are also
on 20-year rolling period,
right?
Not individual. Because if you look at just the 1 year, we got 590 out of 1,050, the 56%. So only 56% of the time is value going to be growth, looking at each month.
Right. So this is where diversification is really important, that when growth isn't performing as well, you've got value to pick up the slack, and vice versa.
Yeah. And this is the 1 year, not month, but it's on a monthly basis, the 1 year rolling time period. 56%. That's a little better than half. But boy, when you get to the 20-year, what a difference. So let's take a look at the growth of 100,000. We start off at 100,000 in December of '89. We'd have $993,542 in there. Okay, and this is for the S&P 500. Now that looks pretty good, right? You can't complain about that.
No, I wouldn't complain.
I mean, that sounds good. But let's take a look at something else. How does it compare to dimensional large cap value, which we have in our portfolio, $1.4 million?
Wow.
That's almost $500,000 more.
Wow.
I think I'll take that. Small cap, oh my goodness, we're over $1 million extra. Oh, dimensional micro, 2.275. How about small cap value? Ooh, $3 million. I'll take an extra $2 million.
Yeah. So
okay.
When you compare it to other indexes, you can see that that's the three-factor model right there.
There it is.
And that's why it's so important that a portfolio is designed
to pick up these premiums.
Yeah.
You're right. Because here's value and small. Here's small. Micro cap is small. Here's small again. Okay, and here's large down here, large value. So if you want to pick up the premiums and you want to get your dollars working harder for you, You got to make sure that you have
Tracking
these
those areas, yeah.
Right. And that's the three-factor model. So this gives you an idea of why we're not going to look like the S&P 500 and why we do not want to look like the S&P 500. And we won't move into the S&P 500 in any year that looks good, because the only time that we know that it's going to outperform the other areas is after it's already happened.
Right, and you know, in the myth seminar, we talk about not stock picking, not market timing, and not track record investing. And so this is really would be equivalent to market timing, because you're just going to try to move from one sector to the next sector based on what this year did. And we have this really great slide, and it will show like all the different asset categories, and it's all color coded, and you're like, okay, based on 2014, can you tell me which area is going to be up in 2015? And you look at it, it's so random, nobody can pick out or guess which one is going to be the number one performing area next year. So if they can't figure out what area of the market, how are they going to figure out a fund or a stock even? I mean, it's just impossible. I mean,
and the best part of it is, if they knew, do you really think they're going to tell you?
Of course not.
Are they going to be on TV talking about how they know this and they knew it and they've made billions of dollars? No.
Well, let's talk about TV anyways, because a lot of people that are getting scared and wondering if they need to do something different to their portfolio, what are they doing? They're watching TV.
Right. And what does TV need to do? It needs to sell either fear or it needs to sell greed, because those two things sell, which means people will tune in, which means their advertising dollars go up. So they are going to hype whatever they can hype or whatever they can do to get you excited enough that you will tune in and focus on what they're doing, and that helps their ratings. They are trying to sell ratings, not education. They're not trying to help you out. They're not doing you any favors. So just look at it, if you have to, as investainment. It's entertainment in the financial world. Do not use it for advice, and do not react to the fear that they're trying to sell.
Great. So if you have any questions, if you have seen something on TV that you're just concerned about, just give us a call. That's what your investor coach is here for. They're going to actually break down the truth for you, and that way you can make a smart decision. And that's what we do here at Smart Plan. So if you have any questions, give us a call at 561-744-9547, or visit us on the web at www.smartplanjupiter.com.
And if you'd like a copy of any end notes that back up the information that we presented, give us a call and we can send that to you. I've already scrolled. That's what I was scrolling through as we were talking. So.
Have a good day.